joining us today for the Snell and Wilmer Employee Benefits Update Hot Topics for 2015. Before we get started, we would like to introduce ourselves. My name is Nancy Campbell. I'm a partner in Snell and Wilmer's Employee Benefits and Executive Compensation Group. My practice is concentrated on health and welfare plans and qualified plans. I've been helping my clients comply with healthcare reform compliance issues since it was enacted almost 5 years ago.
My name is Ann Meyer. I'm a partner in our firm's Employee Benefits and Executive Compensation Group. My practice is concentrated primarily in executive compensation and qualified retirement plan matters.
My name is Kevin Hogan. I'm an associate in our firm's Employee Benefits and Executive Compensation Group. My practice is focused on qualified plan corrections and fiduciary issues surrounding investment management arrangements.
My name is Greg Gautam. I'm an associate in our firm's Employee Benefits and Executive Compensation Group. My practice focuses on executive compensation issues and advising clients on benefits and compensation issues in connection with corporate transactions.
Just so you know, you can hear us, but we can't hear you. If you experience technical difficulties, please use the chat feature and send your issue to tech support. If you would like to ask a question, please use the chat feature and send your question to Q&A. If you use the chat feature to post a question or to ask for tech help, other attendees will not be able to see what you post. Kevin will be monitoring questions as we go. Occasionally, he may jump in with a question, especially if he sees numerous people asking the same question. He will save other questions until the end. If we don't get to your question, we apologize. If anyone has to sign off early, we will be recording the presentation so you may listen to it later. We will be posting the webinar at our homepage, swlaw.com, and it usually takes about 24 hours to post the recording. With that, we'll go ahead and jump into the substance of our presentation. The purpose of this presentation is to give folks a high-level overview about numerous topics. So we're going to be covering a lot of material in a very short amount of time. And so the idea is, again, just to help our clients and our friends to flag issues they really need to be thinking about this year with respect to their employee benefit programs. We're going to get started with health and welfare plans. And the reason we're going to do that is because that is probably substantively one of the hottest topics there is right now. And that's because we've got a couple really big changes on the healthcare reform side of things. One question I keep getting at cocktail parties is whether healthcare reform is here to stay. This is a question I'm getting all the time. This is really confusing for employers because there have been recent changes in Congress, and some people assume now that the Republicans control both the House and the Senate that could mean that healthcare reform could get repealed. And the Republicans have actually now voted close to 60 times since healthcare reform was enacted to repeal it. But that doesn't mean that healthcare reform is going away, and that's because we still have got a Democratic president, and he's indicated that any repeal efforts would probably be vetoed. In addition to just general talk of repealing the whole act, we also have got some legislation that's a little bit more targeted in its scope. For example, I'm going to be talking about the large employer penalties at some length today. And there was a bill recently introduced to raise the hour threshold from 30 to 40 hours in determining who's a full-time employee. Even that more targeted legislation is probably not likely to pass. Another thing that's confusing for employers is the King versus Burwell case. This is a case that's been getting some press recently. It's pending before the United States Supreme Court, and oral arguments were held March 4th. So just last week we had oral arguments in this case. And at issue is whether residents of states that have federal health care exchanges are eligible to receive subsidies from the federal government to pay for health care coverage from those exchanges. The IRS issued guidance indicating that even if the statute was ambiguous on this point, it adopted a reasonable interpretation indicating that folks in the states that have the federal exchanges are eligible to get the subsidies the same way that people in the states that have the state exchanges get the subsidies. And so that's at issue now, is whether or not that the IRS had authority to construe the statute that way. Now, regardless of how the IRS actually holds in this case, it really does not mean health care reform is going away. Some people just mistakenly think if the Supreme Court holds against the Obama administration that this means health care reform is going away, and that's not the case. So my advice would be for folks to move on with their health care reform compliance efforts. Okay, let's go ahead and move on to the large employer penalties. And I'm going to focus on this this is what I'm going to spend the most time on today. These rules took effect January 1 of 2015, and we're actually in a one-year delay right now. They were supposed to take effect January 1 of 2014, but they were delayed until this year. So we are now in the penalty phase, if you will. So employers need to take these rules very seriously if they haven't already done so. The first thing that people need to do, of course, is determine whether you're a large employer and whether or not you are subject to these rules. So the first slide I've got here or the first bullet on page 5 is just asking yourself, are you a large employer? Now, if you have a set of companies that's related, it's part of a control group or part of an affiliated service group under IRS rules, you need to look at all of those companies' employees and add them together for purposes of this rule to determine whether or not you're large. So if you had 3 related companies, each that had 49 employees, you put those together, you have 147 employees. And so each company would be large, even though each company standing alone is small. So the cutoff here is 50 full-time employees. If an employer during 2014 had 50 or more full-time employees, and then you also have to look at your part-time employees. That's what I call the full-time equivalents. You basically take your part-time employees, you have to aggregate them together and come up with an equivalent number of full-time employees. If you had 50 or more of those folks in 2014, that means you're a large employer for 2015. There is a special rule. If you do that calculation, you come in between 50 and 99 employees, then in 2014, you actually get a one-year delay until 2016 to be considered large. However, you need to be really careful because there are some special rules and requirements you have to meet to get that transitional relief. So if you fall within that 50 to 99, make sure to look really careful at the regulation to see if you get the benefit of that additional one-year delay. The next thing you need to think about is whether your standalone company or each company in your control group is going to use what's called the monthly measurement method or the look-back measurement method to track full-time employee status. And full-time employees right now, it's somebody who's working 30 hours or more per week or 130 hours per calendar month. So full-time is not 40 like a lot of us think of it. It's using a 30-hour rule. Now, if you do have some related companies in a control group, different companies here can make a different decision about which method they want to use. The monthly measurement method is really very akin to how employers have traditionally tracked hours. You just do it in real time. You look at the month of January. Did somebody complete 130 hours in the month of January? If so, they're full-time for that month. You can see, though, the danger in doing that because let's say you have an employee who's slated to work 28 hours a week, but they actually end up working 32 hours a week during the month of January because they were busy with some special project, for example. All of a sudden, you've got what you think is a part-time employee, you didn't offer coverage to them, and now they were actually a full-time employee. You get enough of those folks, and it could cause you to fail some of the tests that I'm going to be talking about on the next slide. The look-back measurement method was added to the regulations. It's an IRS rule, and it's really designed to help companies who have a lot of those variable hour people, people that might be working 28 hours, 32, back down below 30, back up. Or a lot of people who have seasonal employees. For example, you operate a ski lift, and so you have a lot of seasonal employees you hire. The look-back measurement method is designed to help people with those types of variable workforces. You pick a measurement period, for example, a 12-month period that might run from October to October of every year. You look at that period and you determine whether people averaged and were full-time employees over that longer period. And if they were, you then offer them coverage for the next plan year based on their being a full-time employee. So that look-back measurement method is kind of a safety net for determining full-time employee status. So these rules are a real sea change for employers because we've never really before had a rule that says employers have got to offer coverage, whether it's a 401k plan or a health plan, to employees. But now we have a rule that says if you don't offer minimum essential coverage to at least 70% of your full-time employees and their children, then you're going to have to pay a penalty. And the penalty that we're really trying to avoid at any cost is the subsection A penalty, which a lot of folks refer to as the sledgehammer penalty. And the reason that this is a sledgehammer is because if you, for example, offer coverage to only 69% of your employees during, for example, January of 2015, you would have to pay a penalty of $167 for that month for every single full-time employee, minus you get a pass on the first 30 people. If even one employee goes to a health exchange and gets subsidized coverage through the exchange. Now, I think we all have to assume that we're going to probably have at least one employee who might qualify for that subsidized coverage. And so the real gotcha here is that if you don't meet the 70% test in 2015, you again have to pay that huge penalty for all of your full-time employees, even the employees that you offered really great, really affordable coverage to. So this is a very draconian penalty. So what people have to start doing now is, as noted in the last bullet here on slide 6, is you have to start performing monthly coverage testing starting in January of this year. You want to show that every company in your control group separately satisfied that 70% test, that you offered coverage to 70% of your full-time employees and their children during each month. Now, here's the real catch, though. That 70% test increases to 95% in 2016 and later years. What the IRS did is they originally adopted a 95% rule, but in the final regulations that came out last year, they gave us a 70% test just this year. And that's really designed to help employers get their ducks in a row this year, because that 95% test is a very high standard to meet. So this year we have a little bit of play in that rule. One of the things I'm trying to get employers to focus on in this year under the 70% test is whether or not you're properly classifying your common law employees. You can see how if you were at a 72% offer of coverage this year and you misclassified a large enough group of employees, for example, you thought some of your common law employees were actually 1099s, you misclassified them, you don't offer them health coverage. That could cause you to fall below the 70% coverage test. Another problem are employees you get from a staffing firm. If those people are actually your common law employees, then they need to be taken into consideration in all of this, and they affect your coverage testing number. Now, the way you can get around that problem is by negotiating with your staffing firm. You put some magic language in your agreement that says the staffing firm will offer them minimum essential coverage, and you then have to agree to pay more for the employees who have health coverage through the staffing firm than those who don't. And if you meet those rules, then the staffing firm's offer of coverage is really treated as you having made an offer of coverage to those employees. Now, the next part of trying to avoid these penalties is offering coverage, the coverage that you offer, that minimum essential coverage. You want to make sure that that's, quote, minimum value and, quote, affordable for as many full-time employees as possible. Okay, you're trying to minimize what's called the subsection B penalty here. Now, a lot of people call this the tack hammer penalty, because the good news about this penalty is if it applies, even though it's more per month, you only have to pay the penalty with respect to full-time employees who actually receive subsidized coverage through a health care exchange. So let's say, for example, that come 2016, you're at a 98% offer of coverage. You have 2% of your full-time employees who don't take coverage from you, or not offered coverage by you, I should say. They go out and get subsidized coverage through an exchange. It would just be for those people who actually went out and got subsidized coverage through an exchange that you'd have to pay a penalty for. So the idea here is just you want to minimize the group of people that might be able to get subsidized coverage. It's very important that people really gear up for these, the penalties, because the IRS might come knocking on your door at some point in time. So the idea here is you want to start keeping records showing that each company in your group made appropriate offers of coverage to its full-time employees and their children. And what you're looking at here are the open enrollment materials that you would have sent out in the fall of 2015, okay? Did those make an offer of coverage for all of 2015? And who did you send those to? Make sure you keep a list of the people that you made that offer of coverage to. So if IRS comes knocking on your door, you've got proof that you offered coverage. And of course, as you hire new people, you need to show that you're giving that offer of coverage to people as you hire them. And just to reiterate, this is just an offer of coverage. This does not mean people have to accept your offer of coverage. It just means that you have to offer the coverage to the full-time folks. Also consider whether plan amendments might be needed. Especially if you decide to use that look-back measurement method, you might really want to think about doing some plan amendments to show that you're using that. That is really a change in eligibility rules. And I know I've covered a lot in a very short time about these penalties. They're very complicated. I actually have a webinar or presentation I give that's more about 90 minutes on this topic. But for a lot more information, I would suggest that you look at my checklist that I've got noted on the last bullet there on slide number 9. It helps people walk through whether or not they're a large employer. It explains the penalties, how to set up your coverage so it's minimum value and affordable, all of those touchstones that we've touched on today. Next, I want to talk about the Section 6055 and 6056 reporting. This is related to the large employer rules that I talked about because IRS is going to have a way to enforce the penalties. So this is W-2 type reporting of the minimum essential coverage that you offer, and then also the offer of coverage that you make for your employees. The reporting for 2015 will actually occur in January of 2016, but you need to be capturing information now. This reporting applies to both insured and self-funded plans, and it's the Form 1095-B that you use to satisfy the Section 6055 reporting. Now, the 6055 reporting applies to both small and large employers. So if you offered minimum essential coverage to any employees and they took it, you'll have to report that on the 1095-B. The good news here is that if you are an insured plan, it's your insurer who's responsible for the 1095-B reporting. Ooh, I think I advanced one too many slides. Okay. The Form 1095-C reporting applies only to large employers, and this is the form you use for the 6056 reporting. Employers report the offer of coverage they made to full-time employees and dependents, and you indicate on this form whether the coverage you offered was affordable and minimum value. If you're an insured plan, the employer only needs to complete parts 1 and 2 of this form. If you're self-funded, you can actually do combined reporting. You complete all parts of the 1095-C, and then you don't have to do the 1095-B reporting. And I've got a newsletter here noted that's got more information. And actually, since I did this PowerPoint, we have one additional newsletter up on our website about the final forms that were recently released. Another healthcare reform issue I want to talk about today is just the impact generally that healthcare reform has had on certain healthcare arrangements. On November 4th, the IRS issued a notice indicating that it was becoming aware of a new product that people were marketing to employers that would provide minimum value. So this was a type of insurance product that employers could use and basically take the position that they had offered minimum value coverage to their employees, and they could then avoid the subsection A and B penalties. The agencies have indicated that this is a new variant of a skinny plan, and they've indicated that they don't agree that insurance that doesn't cover inpatient hospitalization or physician services can provide minimum value. And they've indicated that they are going to implement regulations in 2015. So if you have that type of an arrangement, you'll need to think about that. Back in November, we also got some guidance on various health arrangements and the impact of healthcare reform. Question and answer 1 clarifies that if you're an employer and you pay either on a pre-tax basis or after-tax basis to reimburse one of your employees for an individual health policy that they get, that violates healthcare reform rules. And the penalty is $36,500 per participant per year. And in question and answer 3, IRS reiterated that you cannot set up a health reimbursement arrangement to reimburse individual policies either. You'd have that same penalty. They also clarified in question and answer 2 that employers cannot incentivize high-risk people in their health plans to drop the coverage and, for example, go get other coverage and give a cash incentive to do that. The agencies take the position that doing that violates various provisions of ERISA. So if that's something you've thought about doing, you do not want to do that. And then most recently, we just got last month, IRS Notice 2015-17. This addresses, again, the issue of employers paying for individual health policies on a pre-tax or after-tax basis. They reiterate, again, that you can't do that, but they do very helpfully give small employers 18 months pass on paying those excise taxes I talked about. So if you're a small employer, then you don't have to pay excise tax penalties for 2014 or the first 6 months of 2015 if you have that type of an arrangement. Small and large employers need to really think about getting rid of these types of programs as soon as possible. The good news is, too, though, that in that notice, the agency specifically said an employer can increase compensation without violating these rules. And that's helpful because if you have an arrangement with an employee to pay for an individual policy, you could actually say, we're going to terminate that arrangement, but to offset that takeaway, we're now going to increase your taxable compensation by some amount, but you can have no strings attached to that compensation. You cannot tell that employee they have to use it for any type of health insurance. So there can be absolutely no strings attached, but that at least will help some employers undo these types of arrangements if they have them. Real quick on COBRA. COBRA is still out there. It has not been repealed. Some people think with the changes in healthcare reform that COBRA is repealed. It has not been. However, the world is kind of different now that we have healthcare reform and we have those healthcare exchanges up and running. For a lot of employees, it might be better to get coverage through a healthcare exchange than to take your offer of COBRA coverage. The agencies last year updated the model COBRA notices to highlight the healthcare exchanges and how for some people that might be better. And so I would suggest employers look at that and consider updating their notices to include that information. Not only might this help your employees, it might also help you because, COBRA is a high-risk proposition. There's an adverse selection problem. And so if you can kind of educate your employees about the healthcare exchanges, they might actually elect the healthcare exchange coverage rather than your COBRA. If you're using the look-back measurement method under the large employer penalties, you also need to think about how that impacts COBRA administration because it does. And also, if you have severance agreements where you say you will subsidize COBRA coverage for some period of time if people elect it, you might want to rethink that a little bit. Again, with those healthcare exchanges out there, people might be better going to the health exchanges. And so it may be better off to offer them additional taxable compensation, again, no strings attached, in order to help people out with their health insurance. And for more information on this, I do have a link to one of our newsletters there. Okay, and then just real quick, finally, same-sex spouse and domestic partner benefits. We now have same-sex marriage legal. It's either 37 or 38 states. I don't know what's going on in Alabama right now, but that was up in the air as of last week. The Supreme Court will hear a case this term that could legalize same-sex marriage in all of our states. But even if that happens, there is no specific federal law that requires employers to offer health and welfare benefits to spouses. Therefore, some employers might just offer coverage to opposite-sex spouses, even though same-sex marriage is legal in many states now. But if you do that, be careful because you could face discrimination claims under city, state, or federal law. Now, there is the possibility that state or city ordinances would be preempted by ERISA, but the Title VII of the Civil Rights Act, which is a federal law, would not be preempted. And so I think people are going to start probably getting pretty crafty in coming up with potential claims under Title VII. It is probably just easier to offer uniform benefits to all spouses, both same-sex and opposite sex, because you avoid potential discrimination lawsuits. If you decide to offer coverage to same-sex spouses, you do have to realize you will have to amend your plans to do so. And once you do that, you also need to give those people all the same protections you give the your other opposite-sex couples. That means things like COBRA, special enrollment rights, the ability to pay for their coverage on a pre-tax basis. And then last, this could be for some employers a good time to rethink your domestic partner benefits. If you only offer same-sex domestic partner benefits and you are now operating only in states where employees can actually go out and legally get married, you might think about getting rid of your domestic partner benefits. If you do so, though, I would just caution you, don't just get rid of those benefits real quick. Give people notice that you're going to get rid of them. For example, you might get rid of them as of 1/1/2016. Tell people now, and then that gives people the chance to go out and get married, and then they would qualify for benefits as a spouse rather than a domestic partner if you get rid of them. And with that, I am going to turn it over to Ann and Kevin on the top 5 qualified plan errors.
As Nancy indicated, Kevin and I are going to spend the next 15 minutes talking about the 5 most common errors that we see in administering qualified retirement plans. These errors and correcting these errors are not new topics, but it's something we think plan sponsors need to be focusing on more than ever. There's been an increase in IRS and Department of Labor enforcement activity, and if the IRS or the DOL audit your plan, the odds are high that they're going to find an error. In 2014, 65% of plans that the DOL reviewed had to make mandatory monetary corrections to their plans or pay fines to the DOL. At the same time, employee complaints to the DOL continue to rise. In 2014, employee complaints to the DOL led to employers making corrections and paying fines equal to $356 million. So with that in mind, we thought it would be helpful to talk about the most common mistakes that we see, and then also how to fix these mistakes before the IRS or the DOL find them, or before an employee files a complaint. So with that, I'm going to turn it over to Kevin.
Thanks, Ann. As Ann said, she and I will be talking about common plan mistakes, and despite their best efforts, we see plan sponsors and other plan fiduciaries sometimes make mistakes while attempting to operate their plans in accordance with the law and also in accordance with the terms of their own plan. The most common mistakes we see fit into the 5 categories listed on the slide, and they relate to eligibility, contributions, distributions, plan loans, and failure to timely deposit contributions. When these mistakes happen, a plan sponsor or fiduciary should take steps to correct it. And also, as Ann mentioned, at the end of our portion of the presentation, she will briefly touch on the available correction programs from the Internal Revenue Service and the Department of Labor. The first category of failures we want to talk about today relates to eligibility. Now, with respect to eligibility, the Internal Revenue Code allows an employer to impose certain restrictions before an employee can participate in a qualified retirement plan, such as a waiting period of up to 1 year, an age limit, or a service threshold of 1,000 hours. Many employers include these restrictions in their plans, but then they need to make sure that they are able to properly determine an employee's eligibility to participate in the plan. We commonly see employers fail to include employees in the plan when they first meet the eligibility requirements, and sometimes this comes from confusion regarding the eligibility provisions of the plan, or it may come from trouble with tracking the eligibility requirements, such as the hours of service. In any event, not allowing these eligible employees to participate in the plan is an error that needs to be corrected. Another error that we commonly see is where plans have an automatic enrollment feature and employees are then not automatically enrolled or provided the initial or annual safe harbor notice describing the automatic enrollment feature. For example, if the plan provides that participants are automatically enrolled after 60 days of employment unless they opt out, the plan administrator must automatically enroll the employee within that time period. Otherwise, you have a mistake that needs to be corrected. As you'll see with most of these errors, the problems are mostly due to a failure to follow the terms of the plan, which is why it's very important to understand all the features of your plan. We just talked about the failure to not include eligible employees in the plan, but we also see a lot of mistakes relating to the inclusion of ineligible employees in the plan. Often this error comes up when an employer has affiliates that have not adopted the plan. If you have affiliates and the affiliates have employees, you need to consider whether those affiliates should or should not be in the plan, and make sure that the terms of the plan are consistent with your intention to either include or exclude those employees. This error commonly occurs where a company has had an affiliate without employees for a number of years, and then for whatever reason the affiliate gains employees and the employees are then allowed to participate in the company's plan. However, no one thought to check the plan document to make sure that the affiliate was an adopting employer of the plan, and to make sure that the employees were actually allowed to participate in the plan. If the employees of affiliates are participating in the plan, the terms of the plan need to allow it. Otherwise, you have a mistake that needs to be corrected. We also see this issue of including ineligible employees come up in the context of a corporate transaction, like an acquisition. If you acquire an entity that has an affiliate, your plan needs to be amended to allow participation by the employees of the affiliate before you actually let those employees make contributions. Lastly, other ineligible employees that are often mistakenly included in a plan are those who have yet to satisfy the age or service requirements, or workers who have been misclassified. And again, these types of failures often relate back to either not understanding or knowing the terms of the plan, or problems with tracking eligibility criteria. The next category of failures we commonly see surround contributions. The number one problem that the IRS frequently reports is a disconnect between the plan's definition of compensation and the payroll system's definition of compensation. So for example, you have a plan that defines compensation as W-2 compensation but excludes certain fringe benefits. However, when those items of compensation are coded into the payroll system, some of those fringe benefits end up getting coded as compensation for purposes of making 401k deferrals. Now, this now allows the participant to make deferrals and possibly get an employer match on items of compensation that the plan otherwise doesn't allow. We commonly see this issue come up when there's non-cash compensation that's paid, such as auto allowances or taxable life insurance. And it also comes up with bonuses, whether bonuses are coded properly and whether participants can make 401k deferrals from bonus pay. To avoid these types of problems, we suggest that the person responsible for the plan and the person responsible for the payroll sit down together at least annually and compare the terms of the plan to the payroll coding categories. Another contribution failure we commonly see is the failure to properly implement an employee's 401k election. For example, you have a participant who elects to change his or her elective deferral percentage from 5% to 10%. The plan has to have procedures in place to make sure that this change is implemented. Now, while this error is becoming less common because most employers' payroll systems are linked to an online election form and the change is then automatically processed, this is something you should focus on if your 401k plan and payroll system are not linked. And then the next bullet there, on the last slide we touched briefly on the failure to allow employees to participate when they should have been automatically enrolled. And another feature of automatic enrollment is that participants are deemed to have elected a certain deferral percentage unless they choose otherwise. And again, employers need to make sure that that's being implemented and that they're making the proper contributions on behalf of the participants. A failure to do so is an error that needs to be corrected. The last category I'm going to talk about before passing it over to Ann relates to plan distributions. And one of the most common failures in this area that we see is improper hardship distributions. If the plan is going to make a hardship distribution, the terms of the plan have to permit hardship distributions. Hardships are only allowed in very specific circumstances, and we routinely see hardship distributions for reasons that are not permitted in either the plan or in the Internal Revenue Code. We also see a number of hardship distributions being made without any supporting documentation of the hardship. Permitting hardships without supporting documentation can be problematic and could end up causing an error. Another common error with respect to hardships is not suspending the elective deferrals for 6 months after the participant receives the hardship distribution, or not automatically turning the elective deferrals back on if that's what your plan provides for. The next bullet there points out the failure to distribute required minimum distributions. The Internal Revenue Code requires that participants take minimum distributions when they reach a certain age, and a failure to make these distributions is not only a plan error, but is also a tax problem for the participant, or can be a tax problem for the participant. To avoid this error, plan administrators should be familiar with the required minimum distribution rules, which are sometimes also referred to as the RMD rules. Lastly, we see some employers failing to offer distribution options made available under the plan, or the opposite, offering a distribution option that is not permitted under the plan. For example, if the plan allows an annuity option, that means you have to make that option available when your employee is ready to retire and take a distribution. And similarly, if the plan only permits lump sums, you can't then allow that participant to, you can't allow a participant to take installment payments. And as with all failures, these should also be corrected. I'm now going to pass it over to Ann Meyer, who will talk about a couple more common failures in the correction systems in place to fix plan errors.
In the past few years of my practice, I've started to see more plan loan failures. One example of a plan loan failure that I've seen more lately is not amortizing the loan over the correct term. Unless the loan is for the purchase of a principal residence, loans need to be repaid 5 years from the loan origination date. The repayment period is not 5 years from the first payroll period following the loan origination date. So in many instances, loans are going to need to be repaid over a period that's slightly less than 5 years. For example, if an employee takes out a loan today, March 10th, 2015, that loan must be repaid no later than March 10, 2020. So if payroll periods are on the 1st and the 15th of the month, the last loan repayment should be for the March 1, 2020 payroll period. In this instance, the loan should be repaid over 4 years and 23 payroll periods rather than the full 5 years. Another mistake that I've seen lately is not updating the interest rate. So for example, if the plan says that interest is going to be charged at a rate of prime plus 2%, make sure you know whether you're required to update prime as the plan sponsor or whether your record keeper automatically updates prime. We've seen improper interest rates charged over a period of years due to a misunderstanding over which party was actually responsible for updating prime. The final failure I'm going to discuss today is one that the Department of Labor has been focusing on in its investigation. It's the failure to timely deposit employee contributions. And this has been a focus of the DOL for the last few years. The rule is you must deposit employee contributions as soon as possible. There's a 7-day safe harbor for small plans to forward contributions to the trust. But if you're a large plan, and one time you forward contributions to the trust in 3 days, and other times it takes you longer, the Department of Labor's position is that you should always be able to forward contributions to the trust in 3 days. So our advice is to be consistent in the length of time that it takes to forward employee contributions. Now, as a practical matter, I suggest sitting down and reviewing how long it's going to take on average to forward employee contributions, and then develop a process whereby you can consistently get employee contributions to the trust in the same period of time for each payroll period. Now, the good news is, if you make a mistake, you want to find it and correct it, and the DOL and IRS have correction programs that are pretty user-friendly that you can use for this purpose. Again, we suggest that you actively look for and correct mistakes. You know, even the best plans always have mistakes. So it's going to be a lot easier and cheaper to fix it yourself than if the DOL or the IRS discovers a mistake, or if an employee complains about how you're administering your plan. The IRS correction program is the Employee Plans Compliance Resolution System, or EPCRS. And there are 3 ways that you can correct using EPCRS. Self-correction, where you find the mistake and you fix it in-house. Voluntary correction, where you find the mistake and you correct it with the blessing of the IRS. And the third, which is audit cap, and that just means the IRS found the mistake first. Self-correction is the easiest because you simply find the mistake, you correct it, and you document it for your file. The IRS has some guidelines for correcting this type of mistake, so you can just follow those and correct the mistake. The program works pretty well for relatively small mistakes, but not all mistakes can be self-corrected. In certain instances, plan sponsors are required to correct mistakes with the approval of the IRS or using the voluntary correction program. Here you correct the mistake and you file an application with the IRS. The IRS then reviews the application and approves the correction. While the voluntary correction program is more involved, the advantage is you have IRS approval on the correction. That can be helpful for plan auditors who sometimes insist on IRS approval. Likewise, if you correct using voluntary correction, the correction cannot later be challenged by the IRS. And then finally, if a plan sponsor is involved in an acquisition, oftentimes the other side wants to see IRS approval of plan correction. And then the third method, or the third IRS correction program, is audit cap. In short, you do not want to be an audit cap. It means the IRS found the mistake before you did, and it's just simply going to be more expensive and more difficult to fix than it would be using the voluntary correction program. And then finally, the DOL has a correction program, the Voluntary Fiduciary Correction Program, known as VCP, to kind of add to the alphabet soup that we have. And that's used to correct ERISA fiduciary violations, things like late participant contributions, certain loan mistakes, and similar issues. And to correct using VCP, you file a fairly short application with the Regional Office of the Department of Labor's Employee Benefit Security Administration. Since Kevin and I talked a little bit about some common errors, I also thought I'd spend the last couple minutes describing how the self-correction program works. So using one of Kevin's examples, he touched on failing to automatically enroll a participant in the plan. This type of mistake can be corrected either through self-correction or voluntary correction. Generally, though, you'd use self-correction for this type of mistake since it usually does not affect many people and the total dollar amount at stake is relatively low. In this instance, the plan sponsor would be required to make a contribution to the employee's plan account. The contribution is the automatic enrollment percentage times the employee's compensation times 50%. So if you assume, for example, an automatic enrollment percentage of 4%, an employee compensation of $20,000, in this instance, the plan sponsor would contribute $400 to the employee's plan account, which is 4% times $20,000 in comp times 50%. If the plan has a match, the employer is required to provide the match on the amount of the participant's compensation times the full 4%. In other words, you don't get to reduce the matching contribution by 50%. So basically the takeaway here is that mistakes happen no matter how well you're running your plan. And we just want to emphasize that we suggest having a process in place for finding the mistakes and correcting them. And with that, I'm going to turn it over to Greg to talk about Section 409A and severance arrangements.
Thanks, Ann. I'm going to spend the next 7 minutes or so talking about Section 409A, severance payments in employment and severance agreements. So Section 409A, it's been around for about 10 years now, but last year the IRS did initiate a limited scope audit project on Section 409A arrangements. In our practice, we see a lot of arrangements that implicate Section 409A, so we thought it would be helpful to give you all a refresher on one of the most common arrangements that has 409A implications, and that's severance payments in employment agreements and severance agreements. So very briefly, Section 409A is a provision of the Internal Revenue Code that regulates non-qualified deferred compensation. Most of the provisions of the Section 409A regulations really focus on the timing and form of payment of non-qualified deferred compensation. So how do you know that you're in the Section 409A world? And it's really this term of art, non-qualified deferred compensation, that tells you that you need to be thinking about these issues. Under those rules, an arrangement provides non-qualified deferred compensation if it gives an employee or other service provider a legally binding right to receive compensation that will or could be paid in a future taxable year. So if I enter into a new severance agreement in March of 2015, and it provides for payments through March of 2017, that's the kind of arrangement that if you're going to enter into it, you need to start thinking about Section 409A and how do I make that arrangement either 409A compliant or fit within an exception to Section 409A. Now, I only have a few minutes, so I'm going to focus on severance payments, but there's a lot of other arrangements that are impacted by Section 409A. That first bullet on slide 29 gives you a flavor of how broad in scope Section 409A is. Why do we care about Section 409A? Well, the penalties for violating Section 409A are significant. First, the employee or other service provider must include the vested deferred amounts in income, regardless of whether the employee is entitled to receive a payment in the year in which the violation occurs. The employer then would have a corresponding withholding obligation on that amount. The big one here is that the employee must pay an additional tax equal to 20% of the amount over and above the regular federal income tax already owed. In certain instances, 409A interest penalties might also apply. So if you have an employment agreement with a CEO and you have to tell him or her that they might be subject to a 20% additional tax over and above the regular federal income tax rates that apply in that arrangement, that's a conversation none of us would want to have. So, I've identified an arrangement that is going to provide non-qualified deferred compensation. How do I make that arrangement avoid some of the penalties mentioned in this slide? To avoid these penalties, what you need to do is you need to structure your arrangement to either be exempt from Section 409A or to comply with Section 409A. Typically, fitting in to one of the exemptions is desirable. It offers a little bit more flexibility. Sometimes you can change the timing of the payment, even the form of the payment. When you're complying with Section 409A, that's a lot more difficult. So there are two exceptions to 409A that really apply to severance payments. The first one is the short-term deferral exception to Section 409A. What the short-term deferral exception says is that Section 409A does not apply to payments that are made on or before the 15th day of the third month following the end of the taxable year in which the employee's right to the payment vests. So for individuals and employers with calendar fiscal years, that key date for the short-term deferral exception is March 15th. So I have an example in there. If I'm going to provide severance upon an involuntary termination that occurs in 2015, I can qualify for the short-term deferral exception if all amounts paid to the employee are paid before March 15 of 2016. So in that instance, I could either provide a lump sum payment that's paid before March 15 of 2016, or I could provide installment payments. And as long as all those installment payments are made before March 15 of 2016, then I've satisfied the requirements to fit within the short-term deferral exception to Section 409A. Now, this issue regarding releases comes into play a couple different places in this short presentation. We think a best practice is in an employment agreement, if it says that your severance is going to be only paid if you sign a release, if the employee signs a release, we think the agreement should say that the release is going to be provided to the employee either prior to their termination, in connection with their termination, or very shortly following their termination, maybe 5 days following the termination. And that would allow the payments to still be made within that short-term deferral period. The second exception to Section 409A that I'm going to talk about is the separation pay exception. What the separation pay exception says is that Section 409A does not apply to payments made upon an involuntary termination of employment if the following requirements are met. All the payments are made by the end of the second calendar year following the year of the involuntary termination, and the payments do not exceed the lesser of 2 times the employee's annual compensation or 2 times the Section 401A 17 limit. For 2015, that's $520,000. If those total severance payments exceed the limit described above, then the amounts paid up to the limit can qualify for the separation pay exception. One of the keys to the separation pay exception is that the severance payments be provided only upon an involuntary termination of employment. So if the arrangement is going to provide for severance upon a voluntary termination of employment, then the separation pay exception is unavailable. Whether or not a termination of employment is involuntary depends on the facts and circumstances. And the 409A regulations do say that certain resignations for good reason will be considered involuntary for purposes of the separation pay exception. A lot of the times you'll see in arrangements good reason definitions that are very similar, and that's largely because it's driven by a safe harbor in the 409A statute that prescribes what kind of good reason definition is, in fact, voluntary. Now, if you find yourself in a situation where you can't comply with short-term deferral or can't comply with the separation pay exceptions, you need to structure your agreement to comply with Section 409A. In that instance, there's a number of technical rules that apply. I'll just touch on a few of them here. The first one is that since we're talking about severance, the payments must be made upon the service provider's or employee's separation from service. It's a technical term of art that I put directly into the slide, but I think the key thing to recognize is that it's really triggered upon the level of services that the employee is providing. So you could have a situation where you have a separation from service, but someone is still technically an employee of the company. Payment made to certain public company offers that are triggered on a separation from service must be delayed for a period of 6 months following the separation from service. And this last bullet gives some detail on some specific magic release language that must be put into an agreement that complies with Section 409A. And with that, I'll turn it over to questions.
I have a couple of questions that came in early. One of them is, does the 70% test, is it just that you have to offer coverage to your full-time employees, or do they actually have to be enrolled? And that's a really good question, and so I'm sorry if I didn't make that clear enough. It's only about the offer of coverage that you make to people. You just offer them coverage, even if you only have 25% of the folks that accept your offer. If you're at 70% this year, 95% in future years, you'll still satisfy the test. I got another question. Is 50 the threshold to determine large employers for the Section 6055 and Section 6056 reporting? Now keep in mind the reporting that you do for MEC, that applies whether you're small or large. But the answer is yes. For the 6056 reporting, it's the same 50 cutoff that you use. Also importantly, if you fell within that special rule I talked about where you were between 50 and 99, so you're not technically large in 2015, you still will have to do 6056 reporting for 2015. Did anybody?
Yeah, we have another question. This one relates to what you talked about, Ann. What happens if an employer is in the middle of correcting an error through the IRS's, through EPCRS, through the IRS's correction program, and then during that time the IRS audits the plan?
It depends on whether you're in the middle of self-correction or voluntary correction. So if you're self-correcting, where you're correcting in-house without IRS approval, in that instance, the IRS's position is that it can still audit the plan and it can and will look at the failure that you're correcting. On the other hand, if you're doing voluntary correction and you've submitted your failure to the IRS for approval, a lot of times the IRS will hold off on the audit altogether, but you know, in some instances they'll still come and audit the plan, but they will not look at that failure. So you've got some protection while your application is pending with the IRS.
I had a question, and it was a really good one. It said, if I find a Section 409A failure, can I fix it? And the answer is, in certain cases, you can. The IRS has come out with 2 formal correction programs. Notice 2008-113 helps service providers correct operational 409A failures. There's another notice the IRS came out with, Notice 2010-6, that helps folks correct Section 409A document failures. There's also, in certain instances, you can informally correct outside of those two formal IRS programs. Whether or not informal correction is available depends on the facts and circumstances.
I've got another question here. Any chance the large employer penalties will be delayed again? That's a question I actually get a fair amount. The penalties originally, they were supposed to take effect January 1, 2014. IRS announced the delay in July of 2013, so 6 months in advance of the rules when they were supposed to take effect, they announced the delay. I really don't think that this is very likely to get delayed again. I've heard really no talk of a delay. I think if there was going to be a delay, it would have been announced before we actually went into the penalty period. And I also think the regulations are really in pretty good shape at this point. They were not as in good shape before the 2014 year started. And I feel like the IRS delayed the penalties the one time because the regulations were a little gray, but now that they're in better shape, I think that they feel comfortable enforcing the rules. Another thing people need to keep in mind is that, this is really a very big revenue raiser for these healthcare reform rules. This is all very interrelated. And so, they've already given up potentially 1 year of penalties, and if they were to delay it again, they'd be giving up yet another year. So I really don't think a delay is likely, and so again, I would just urge employers to, move forward with their compliance efforts.
I had a question on the error of the disconnect between compensation definitions with your payroll and your plan definition, and how do you fix that mistake? There are a few ways you can do it. If you have included something in compensation through your payroll that wasn't included, that shouldn't have been included because it's not in the terms of the plan, you can reduce the participant's account. Or if the opposite happens, where something wasn't included that should have been included, you can make that up to the participant by making a corrective contribution. And you can do that either through self-correction or the voluntary correction program. The other correction method is retroactive amendment. And so you could basically you amend your plan to say, well, we were always including this item of compensation, or we were always excluding this item of compensation, and then you wouldn't make any adjustments to the participants' accounts. I think, as Ann mentioned, there's a benefit to going through VCP, that you get the IRS's blessing. But you also have to remember that if you are doing the reduction or the corrective contribution to participants' accounts, that you have to account for earnings.
I've got one other question. Somebody asked, is it better to use the monthly measurement method or the look-back measurement method under the large employer penalties? And, there really is no better. It really depends so much on your situation. Do you have those variable hour or seasonal employees? I will say that I think the look-back measurement method for a lot of employers is the safer method, because there are a lot of, nuances to using the monthly measurement method. And if you just don't understand those nuances, you could be safer using the look-back method. Another thing I should mention is I've had a couple conversations with some payroll vendors, some benefits consultants, and some of those folks are indicating that they are strongly urging their clients and really kind of just supporting clients that are using the look-back measurement method. So that's something to keep in mind when you're going through this. If somebody's going to be doing reporting for you, make sure that they understand that the implications of doing that, if you will. I think we are just about out of time. Did we have... Okay, let's go ahead, and I think we'll close up with that. We know we covered a lot of information today in a very short amount of time. For more information, please visit our website, swlaw.com. Also, please see these 3 to-do lists that we have noted here on slide 37. Those to-do lists identify numerous other issues that we just didn't have time to talk on today, but would really serve a lot of people as a good way to make sure that you're keeping in compliance with all the recent changes in the law. Again, thank you for joining us today, and if you have any questions that weren't answered during the presentation, please feel free to contact any of our speakers as follow-up.